Welcome back to the deep dive. Today we're tackling something pretty significant, a major institutional shift brewing in the crypto world. We are diving deep into the launch of Evernorth. That's a planned, $1 billion initiative, all tied directly to XRP. So let's break it down. What exactly just happened here?
Well, we've got Evernorth. It's basically this new digital asset treasury vehicle. And it's got serious backing Ripple plus some big crypto firms. And they're not doing a standard IPO. They're looking at a SPAC merger, Armada Acquisition Corp. 2, I believe.
That's right, a SPAC.
And the aim, it's massive. Raise over $1 billion to build the largest publicly traded treasury of XRP. It'll trade under XRPN.
Yeah, and this is where it gets really interesting. It's not just, buying a bunch of tokens and sitting on them. This signals something bigger, I think, a kind of strategic shift. Instead of just holding the token, institutions are now building these, asset holding companies around the token. Publicly traded ones, it really speaks to institutionalization, and it might, change how these big token ecosystems compete. Okay, let's get into the mechanics. $1 billion is a huge amount of money, especially through a SPAC. Maybe first, why the SPAC route? Why not a traditional IPO for something like this?
Well, a SPAC, a special purpose acquisition company, it's often seen as a faster way to get onto the public markets compared to the whole IPO process anyway. And for Evernorth, dealing with an asset like XRP, which can be complex, maybe volatile, the SPAC gives them speed and a clearer path to that $1 billion target within a structure that's already sort of institutionally vetted. It lets them hit the ground running on the acquisition phase.
Right, speed to market. Makes sense. So once the deal closes, hopefully, what's the immediate plan for all that capital?
The main focus definitely is buying XRP, hitting the open market to build up that huge treasury base. But, and this is really the key difference from, say, just a company holding cash reserves, it's not passive. It's not just buy and hold.
Right, okay. Our sources were clear on that. It's active management. They're talking about deploying funds into institutional lending and also DeFi yield strategies, providing liquidity too.
Exactly. That multi-pronged approach, holding and deploying, that's the core shift here.
Okay, but hold on. Isn't there a bit of a contradiction there? They're pitching this as like a regulated capital markets grade vehicle, something stable institutions can buy into. But then they plan to put a chunk of this $1 billion treasury into DeFi, which, let's be honest, can be pretty opaque, high risk, vulnerable to exploits. Doesn't that kind of undermine the whole institutional credibility angle?
That's a really good question, a necessary one, I think. And yes, it absolutely introduces significant execution risk. We definitely need to talk more about the risks later. But the strategic reason they have to chase yield, or at least plan to, is crucial. A publicly traded company holding assets, it generally needs to show more than just the asset going up in price. It needs to generate some kind of return on the asset itself, alpha, basically. So they need to deploy that capital, use it to try and justify a valuation potentially higher than just the raw value of XRP they hold. It's definitely an attempt to merge, traditional treasury functions, putting capital to work with crypto's unique yield opportunities, despite all the risks that come with that DeFi part.
Okay, so the structure itself, this public company, is meant to be the engine for generating that yield, improving the model. Got it. Let's pivot then. Let's talk about XRP itself. For years, Ripple has positioned it as, a payments asset, a settlement bridge currency, utilitarian. How does a $1 billion publicly traded treasury change that story?
It fundamentally reframes the narrative. It tries to lift XRP out of just competing on payment processing speed or cost and places it into a whole different category, a publicly listed, institutionally backed treasury like this. It's a clear push towards becoming a kind of digital reserve asset.
Digital reserve asset. That's a big claim. What does that imply practically?
Well, think about what entities hold reserve assets traditionally. Central banks, sovereign wealth funds, major institutions. If Evernorth succeeds, it positions XRP less as just a competitor to SWIFT and more as something that could potentially sit on the balance sheets of these massive players. Players who look at assets for long-term stability, deep liquidity, strategic importance. It suggests a role far beyond just facilitating transactions. It's aiming for foundational status.
That's a powerful reframing. And the credibility comes partly from who's behind this, right? The backers are key.
Absolutely crucial.
We're looking at Pantera Capital, Kraken, GSR, and SBI. They're putting in the first $200 million. That's a serious coalition.
It really is. Having that specific group, a major crypto VC, a top exchange, a global market maker, and a big Japanese financial institution that is the institutional scaffolding. That lineup is what helps shift the perception, like you said, from maybe crypto startup towards something that looks and feels like capital markets grade infrastructure. It signals buy-in from different corners of the financial world, not just crypto natives. Traditional players are seeing the potential in packaging tokens this way.
So Ripple itself, what's their game here? Beyond just the narrative boost, which is obviously huge.
Oh, the benefits for Ripple are significant. Multiple layers. First, it helps create sustained, deep institutional demand for XRP. That's fundamental. Second, if Evernorth pulls this off, buys and it essentially locks up a large amount of XRP in this public treasury, it structurally tightens the available supply. The free float shrinks. That's generally supportive for the price, obviously. And third, maybe most importantly, it offers this highly visible, potentially more regulated gateway for big money. Capital that maybe can't or won't just buy tokens directly off an exchange. It wraps the token in a structure that traditional finance understands and can potentially access more easily. It legitimizes it through finance's own mechanisms.
Okay, the strategy makes sense. It's clever market engineering, really. But let's zoom out again. If this really is a tectonic change, as you put it earlier, how should you, our listeners, think about this? Why should someone care if they don't even hold XRP? What does it mean for an investor, a trader, or someone just building in this space?
Okay, for the maybe more passive investor, Evernorth offers a completely new way to get exposure. You could potentially buy XRPN, the stock, instead of the token XRP. For large institutions or even some retail folks, that might feel like a lower barrier, more familiar, maybe more regulated than dealing with crypto exchanges directly. It's essentially Wall Street creating a product for Main Street built around a crypto asset.
Interesting. And what about the active traders, the ones watching charts, looking for short-term signals?
For them, it really comes down to supply and demand dynamics. It's critical. If, and it's still an if, but if this billion-dollar treasury gets built, it will noticeably reduce the amount of XRP readily available for trading the free float. Think of it like inventory. If a huge buyer consistently takes inventory off the shelves, then any new demand has less supply to meet it. That can lead to sharper price moves. And it gives traders a very visible signal of institutional buying pressure, of supply being absorbed. They'll need to watch Evernorth's acquisition reports very closely.
Wait a second, though. If this works for XRP, the real impact isn't just on XRP, is it? This could become the playbook for other major tokens, couldn't it? This changes the whole competitive dynamic.
Exactly. That's arguably the biggest, most profound implication here. If Evernorth pulls this off, if it executes well and gets regulatory acceptance, this model could absolutely become a template. You could easily imagine other major ecosystems. Think about leading layer ones, Solana, Avalanche, maybe even big DeFi players trying to launch their own token treasury companies.
Wow.
Competition suddenly wouldn't just be about tech specs like TPS or developer communities. Those still matter, of course. It would shift towards which ecosystem can attract the biggest, most credible capital markets vehicle to back its token. It's like professionalizing ecosystem treasury management on a whole new level. That's a competitive battlefield the crypto market hasn't really seen before.
Okay, but that brings us squarely back to the risks. We need to be super cautious here. $1 billion SPAC tied to a volatile asset with plans to dip into DeFi. What are the biggest risks right now, and what should we be watching?
Risk number one, right out of the gate, is plain old execution risk on the corporate side. Closing a SPAC deal is complicated. It needs approvals, shareholder votes. They're aiming for Q1 2026, but delays happen. And any significant failure or regulatory roadblock there could seriously hurt sentiment, not just for XRP, but for this whole treasury company concept.
And assuming it gets off the ground, what about the risks of actually running it?
Then you have concentrated asset risk. Holding that much XRP means huge exposure to its price swings, obviously, but also to any regulatory developments, specifically targeting XRP. And circling back to your earlier point, deploying capital into DeFi adds another layer. Operational risk, smart contract bugs, even liquidity risk. What if they need to pull funds out quickly during a market crash? These are serious considerations for any public company, let alone one built around crypto. Not trivial at all. So given that timeline, Q1 2026 maybe, and all these risks, what are the key things listeners should track over the next year and a half? Okay, first metric. Watch the SPAC deal progress like a hawk. Timelines, announcements, regulatory filings. That's the immediate hurdle. Second, once it's live, track the XRP acquisition. How much are they buying? At what average price? How fast are they moving towards that billion-dollar target? Are they actually doing what they said they do? Third, and this might be the most critical long-term indicator, governance and disclosure.
Transparency, basically.
Exactly. As a public entity, Evernorth needs to be transparent. They should publish regular updates on their holdings, explain their risk management, and this is key report on the actual yield they're generating from lending and DeFi. If they're opaque, they won't build that institutional trust they're aiming for. Transparency is the benchmark here.
And let's not forget the elephant in the room, regulation. A U.S. public company buying crypto, using a SPAC, planning DeFi activities, that's like waving a giant red flag at regulators worldwide, isn't it?
It absolutely guarantees intense regulatory scrutiny, no question. That scrutiny could mean higher compliance costs, stricter reporting rules, which could definitely affect how the market prices Evernorth's stock, XRPN, and how regulators ultimately view that yield generation piece, especially the DeFi part, will be massive for the long-term viability of this whole model.
Okay, so let's try and pull this all together. We've covered the potential shift for XRP from payments to reserve asset, the SPAC mechanics, the active management risks, and this huge potential for replication across the crypto space. What's the practical takeaway? If I'm a long-term holder, maybe I'm looking at this from a portfolio strategy angle, what should I be thinking?
For long-term believers in XRP, this is arguably a very bullish structural development. It signals deep institutional commitment and provides a potential demand sink. But you have to constantly weigh that potential against the execution risk. The SPAC needs to close, the strategy needs to work. It's not guaranteed. For portfolio managers, well, you now have a fascinating new choice. Do you invest in the token XRP directly, or do you invest in the public company built around the token, XRPN? You have to evaluate the performance, governance, and risks of the treasury company itself, potentially separately from the token's own merits. They become distinct investment options.
And what's the big caution? Because we've seen hyped treasury plays before that didn't quite live up to expectations.
The key caution is exactly that. Look beyond the initial announcement hype. Don't just assume it deserves a premium valuation because the idea sounds good. Evernorth's real value, its long-term success, will be judged by its actual performance, how much XRP it acquires, the yield it generates, how well it manages risk, and crucially, by its transparency and disclosures. Performance matters way more than promises.
Right. So clearly Evernorth's launch is a significant moment. It does feel like it signals this ongoing transition of major tokens becoming, capital market grade assets that need sophisticated financial structures built around them.
I agree. It's a major signpost. Now, whether this specific model becomes the template for other ecosystems that really hinges on Evernorth's execution, market reception, and especially getting regulatory clarity, particularly around those DeFi yield strategies. We absolutely need to keep a close eye on these institutional infrastructure plays. They often pop up just before bigger shifts in market cycles.
Okay, great insights. Before we wrap up with our final thought, just a quick note. If you found this deep dive helpful today, if you got value from us breaking down this complex institutional move, please consider subscribing, maybe leave a comment, hit the notification bell. It genuinely helps support the channel, makes us more visible in the algorithm, and allows us to keep creating this kind of in-depth, source-based crypto analysis for you. We really do appreciate your support.
Absolutely. And maybe here's something to chew on as we finish. As Web3 finance evolves, we're seeing this merger of tokens, traditional treasuries, and institutional structures. If you really want to understand where the capital might flow next, maybe pay a little less attention to just what the tokens do and a bit more attention to how the fundamental architecture of owning those tokens is changing. That's where the really interesting shifts might be happening.